Breaking live from the Thinkorswim studios in Chicago, Illinois, on the banks of the Chicago River. Welcome to a Monday edition of Fast Market. I almost said swim lessons. That's going back to the past.
There we go.
Yeah. Or what we like to call Jerry Springer and Brooks Brothers. All right, I want to welcome in Scott Bauer, CEO of Prosper Trading Academy, and TD Ameritrade's own Jenny Horn, who joins us every day. Good to see you guys.
Happy Monday. That was
Happy Monday. Good weekend.
Great intro.
Yeah, exactly. So here's what we got. Monday, start of earnings season. The banks kick us off. Interesting trade this morning so far out of Citigroup. Good numbers, beat on EPS, beat on revenue, some light. As you dig into the numbers now, a little light. Opened it higher, sold it off hard, and now it's come back to basically unchanged here, up 7 cents. So a big nothing burger with a big movement, though, in Citigroup. But here's the thing. Citigroup's unchanged. The rest of the financials are all lower because I think that earnings kind of shook some of the financials. But I thought some of the metrics on Citigroup's earnings, you guys, were actually okay. I like the fact that trading revenues were all a little bit better. You knew net interest margin was going to struggle, right? In a quarter where the 10-year yield goes straight down to 1.94, you're not going to get great net interest margin numbers, but trading's picking up because the markets did move during the second quarter. So all things positive. Scott Bauer, your take on the beginning of earnings season.
Yeah, and I think the banks are going to lead us higher. I really do. And you know what? That's okay that Citi sold off after the good numbers. The bottom line is they reported good numbers. I've been talking about this for a while, like you just said, Kevin, that I think the big guys, Citi, JP, Goldman, are going to report really good trading numbers.
That's what I've been saying too.
Because the last quarter, we've seen volatility.
All you got to do is look at the movement, right?
Exactly.
We went up, down, up during the second quarter.
That's what they need.
Bonds were strong. Jenny, this market is moving. Did our younger traders noticing actual market moving? Obviously, interest rates aren't helping these banks.
See, I'm kind of disappointed with the morning's move because we see Citi is only up, 0.2%. I'm surprised it was more of a muted reaction. And you see the markets really aren't doing that much. PNC, Jpmorgan down 0.5%. I mean, I'm surprised there wasn't more of a movement. But I guess there's more numbers to come.
And we know this. It's easy to disappoint, right? If you got to really do well across the board, and some of the numbers were light, right? And the expectations for some of these banks are low. That's why I think the way Citigroup ends the day is going to be so important. There's a lot of, that's what this market's going to do up at all-time highs. There's going to be a battle between higher, lower. Are we at all-time highs? You got to sell every rally. There's so many things, so many decisions to make up at these levels that it's going to be a heavyweight battle for sure, Scott.
Absolutely. And without breaking it down into the very, very minutia and micro data, if you look at these big banks and you say 9 months ago that we would see the 10-year go from over 3 to down below 2, and these banks would almost be unchanged over that period of time, to me, that's a huge win.
Exactly right, because they have weathered an unbelievable storm, a hurricane-like storm that they've weathered, because normally the correlation between banks and the 10-year yield, they're in line, right? When 10-year yield's going higher, banks go higher, and the opposite. So Scott's right. The fact that they've weathered a pretty good storm, and here's a couple things that I want to know your opinion on. Book value, right? It's that sneaky number that comes in that gives a kind of a baseline for what these banks are. And the book value for Citigroup, $79.40. That's, $7 lower than we're trading right now. And people think about that because that's all their assets, everything combined into one, and for a book value of the company.
Yeah, that's kind of wild.
Yeah, so I mean, if people think, wow, that's undervalued. So in an economy where so many things are high and elevated, retail, banking, maybe places where people are going for bargains at the all-time highs if you got to go somewhere. Scott?
Listen, I think the banks are at a bargain right now because of what the market expectation is for the Fed. If we get one cut, which more than likely is going to happen in the next couple of weeks here, I think the banks actually do really well with that. Now, the rest of the year will really depend, for the banks, will really depend on two things. How the market reacts and trading revenues, and then also, are we seeing 2 or 3 cuts, which I don't think we are. And if we
do you think we're seeing 2?
I don't think we should even have one.
I agree.
We should not even have one.
I agree too, but I think Jerome Powell's getting dragged, kicking and screaming
out to the woodshed.
Really because of the Fed funds rate.
Yep.
Right? Is really driving Jerome Powell. He can't look at a Fed funds rate where that is and say, I'm not cutting, because that will shock the market, and they don't like to do that.
Right. We've mentioned a few times, it's hard to argue with the Fed funds rate, but banks are not the only companies that have earnings this week. Let us not forget.
Yes.
We have JB Hunt's post-market today. Tomorrow, of course, we have Jpmorgan, Wells Fargo, Goldman Sachs, Johnson & Johnson, Domino's Pizza, which we'll talk about later on, United Airlines, and then Wednesday, more banks, Bank of America, US Bank Corp, Netflix, eBay, IBM. I mean, the list just goes on and on. Thursday, Honeywell, United Health, Microsoft, Union Pacific. So this is a busy week for more than just banks.
Scott, I made a joke last week that all the earnings up until now were like Tom Dreesen opening for Sinatra. And guess what?
And no one got the joke.
No one got my joke.
I got it.
Yeah, see?
I got it.
Finally someone my age group that gets my joke.
Alex and I were like, huh?
Like, for goodness
we're either
sake.
of those people,
yeah,
right?
Exactly. So, okay. Today's data, very regional. Empire State Manufacturing, nice recovery, but not a number that's going to move the market on a day like this. But tomorrow, retail sales, import-export prices, industrial production, 3 good ones in terms of the overall health of the economy and GDP, right? 2 of those, industrial production and import-export, will feed into GDP. What are you thinking?
I'm actually really keying in on retail, because what I thought interesting last night with the news out of China, lower numbers overall, but their retail numbers were actually pretty strong. I want to see if ours are the same. And if ours are even just mediocre, they don't even have to be above expectation. If they're mediocre, that is going to fuel, in my opinion, the rally that we've seen.
Jenny, do we have anything besides tomorrow for the rest of the week that's going to give us any reason to get our heart rates up? And be careful. You're talking to older people over here.
No, I'm kind of watching retail sales also, and I think what's going to overshadow eco data this week is earnings completely. I mean, earnings is going to be kind of the big theme of this week. And what's interesting about these earnings is it's a bunch of different sectors reporting, right? So
Jenny said it best. Once today starts and you get through today, earnings get heavy. I mean, they come right out of the gate, and they are heavy.
Question:
right?
Do we have Bitcoin earnings?
Yeah, Bitcoin earnings. Yeah, earnings.
No,
what? Let me know when you figure out what that is exactly. But
you mentioned a really good point of if expectations are just in line, it's going to be a good thing. I kind of think the opposite for earnings this week. This is a week where the markets are so high. I think any results could kind of disappoint.
But think about this, and I brought this up on the panel. I want you to realize this: the fourth quarter of last year. Right? Earnings were growing at 20.4%, and the market crashed during the fourth quarter. Now they're supposed to be flat to down small, but this market has rallied to all-time highs and looks unable to really sell off here. The correlation between the two, interest rates, right? You had going in two different directions in terms of interest rates. But so Scott Bauer, your customers, your clients at Prosper Trading Academy, how do you keep them calm and have them focus on the big picture, which is interest rates in a market like this?
You learn to embrace volatility. You embrace it when it's high. You embrace it when it's subdued.
Right.
And I'm looking at VIX right now, and VIX at almost 13 for this kind of this time of the year. That is extremely expensive, at least for over the last.
We've seen a lot lower than this.
Absolutely. So I embrace this going into earnings season right here, and I tell them, don't take again the minutia of the day-to-day talk of interest rates and Powell this and what did Bernanke do in the past. You know what? You have to listen to it, but you almost have to throw it out the window, and you can't get too worked up over the day-to-day. Keep the bigger picture in line and keep it close to the vest in a time like this.
All right, let's keep going here, and let's get to our first trade of the day, our featured trade, which is Johnson & Johnson. Right?
It's been a laggard all year. It's only up 5% versus Dow index is up 20%. So this is a stock that has room to impress us possibly.
Remember, Johnson & Johnson has had a cloud over it most of the year, right? They've had asbestos, allegations of asbestos in their baby powder.
Yep.
They've had their role in the opioid crisis, that everyone's talking about. But a lot of people that like this stock and continue to like this stock say the diversity of their portfolio and some of the names they have in a broad range of sectors is what's going to get them through this.
Yeah, I mean, the news that came out last week, it tanked the stock and really had their backs up against the Alamo, quite frankly.
Right,
and
exactly.
I thought it was overdone. I really thought it was overdone. I expect them to report a decent quarter. I'm looking at, based on where option premium is here and the expected move, we're going to get into this, I think it's a perfect setup for a type of trade like an iron condor where you can play both sides of the market here. But I actually like Johnson & Johnson. I think that big sell-off last week is really an opportunity to get into a company, Kevin, like you just said, with the diversified portfolio where one of these allegations, one of these headlines is not going to take this company down.
Jenny, they have a lot of products in their portfolio.
They do.
Let's just, for my benefit, let's take Rogaine out of the discussion and move right past that to the shampoos and the Aveeno and the Neutrogena and Lubriderm. What is this big enough? Is what they do big enough to overcome some pretty big headwinds here with all these allegations?
I kind of think so, but I also, when you look at the company profile, most of this company's revenue is from the pharma business, and you can see the pharma business is kind of where they make their bread and butter. So even though there are these brands that you hear about that are very popular, I mean, Johnson & Johnson is a well-known brand, a staple in itself. Pharma is kind of its big revenue producer. So that's something to keep in mind.
All right, so trading this name. Scott, $2.80 move, basically. What's that? That's
a little over 2%.
Yeah, no, it's a little, 130, a little over 2%, 2.5%. That's historically small for, as we give it the eyeball test across all the stocks we watch. Not a big move.
Nope.
Not a big move expected. So how do we trade that? You said you favor an iron condor. Is the iron condor right with a move that doesn't seem very big for what's going on in this company?
So I'm actually playing it a little bit wider than the one-day expected move, and I'm looking at what the move is to the end of the week, which is more about $3.50 or so. So if I look at that, and I'm biased a little bit to the upside here, so I don't mind taking a little bit of extra risk to the downside here, keeping my strikes a little bit closer to the downside.
We talk about that all the time, right? It's the iron condor, but you can move the strikes, right, to get long deltas or short deltas based on how you set up your strikes.
Exactly. So I'm looking at like the 133, 131 put spread to the downside, and then the upside, the 137.39.
Let me build that as we're talking here. And there you see an iron condor there, $2 iron condor. That's a massive premium for that iron condor, but there's a reason that it's massive or larger.
I was going to say, tell me why we're doing this then, because we try to avoid massive premiums, correct?
Well, no, I mean, remember, this is a risk-defined strategy, but that premium seems to jump out, and here's why. Let's reset slices and make sure. Actually, it's got why does this have a short delta? Why would that have a short delta if we're more aggressive?
It's a little closer to the downside here, so maybe there's something else in there.
Yeah, let me look.
But this iron condor, though,
I'm surprised it's coming up with a short delta. Maybe did I do 137, 139, 133, 131? Is that right?
Yep.
It's giving us right now a small short delta, and it looks fairly even.
It is. I mean, if you look at this and you look at the expected move based on compared to this with what the break even is. So the break even here is 132 and 138.
Right.
Okay.
Here we can. The Thinkorswim platform allows us to set our break even and throw it on the charts, and you see where the break even's almost 132 and just under 138.
Which puts me right to that expected move, not the one-day move, but I even get a little extra room here going out to that $3.50 move to the end of the week. And to get one-to-one, Jenny, this is why I like this. It is a lot of premium. One-to-one out reward to risk for a credit spread like this, I think, Kevin, you'll say is...
Remember,
it's
only
pretty darn good.
The total risk on this trade is only $2, and you're collecting one. So you've almost made this 50-50,
exactly.
Which for an iron condor is doesn't always happen. Normally 30% is what you're going to get, right? If you can get 30 cents on a $1 iron condor or 60 cents or above, you consider that a good enough trade. This is 50% more than that. So we're happy in terms of that level of premium. Remember, it fits all our three criteria, right? Risk defined, collecting theta, high probability. All those fit in this. So if we were to put this on, let's go 5. Sure. And look at it like that, collecting 94 cents. Look at, if you go put your the icon over, look at, you only have $535 at risk.
Yeah, that's not bad.
With a chance to make 470. So you see what you have there. All right, we are going to create a duplicate order and send that off at the midpoint. You see, all right, let's take a quick break. Jenny Horn, you will come back 2 blocks later for cash tags. What are the Swans talking about today? Or Megan Brantley.
Megan Brantley today is talking about Domino's Pizza ahead of earnings.
Making me hungry.
We've been talking pizza all morning in honor of it.
All right, we'll be back in a few moments after this short break with our charts section. Stay right here on the TD Ameritrade Network Fast Market. We'll be right back. Welcome back to Fast Market, everybody. Kevin Hinks, joined again by CEO of Prosper Trading Academy, Scott Bauer. Scott, this market is now just waiting. It's consumed and digested its earnings for the morning. Yep. Citigroup has gone up, it's gone down. Now it's back really close to unchanged. Now, is this one of those where we're just waiting now for the end of the day and more earnings out of some of the big banks?
Absolutely. I think you're going to start seeing some position taking as the day progresses on here. No question. And like Jenny mentioned earlier, this week is so heavy. You probably start seeing some big interest in Netflix, other stocks like that as well.
Yeah, this is the time of the year where the market doesn't move as much as individual stocks move, right? It's not the market driving individual names, it's individual names driving the market.
Absolutely.
All right. For more, let's get a good look at the financials and the technical analysis on those financials. And for that, I'm going out live to Draper, Utah to bring in Mr. Ben Watson, someone who needs no introduction. Mr. Ben Watson. Sir.
Good morning, Kevin. Hey, how are you guys doing?
It's the most wonderful time of the year, Ben.
This morning. Absolutely. As we start right on into earnings season, I'm going to get you a card this year, Kevin, because this is one of those times where we start to see these banks reporting earnings. We get a little bit of an indication of maybe the direction of the trend for the earnings season. But at the moment, companies like Goldman Sachs kind of going sideways with a little bit of a short-term uptrend here. Now, this has been channeling sideways for a little while. We see a bounce up off of the bottom of the channel. Coincidentally, that bounce comes just as the 50 period and the 200 period simple moving averages are approaching what some analysts refer to as a golden cross. Maybe we'll call it a Goldman cross here at the moment. But breaking out of the channel puts the possible target based on technical indicators up around 240. No guarantee that it'll get there, but if it fails, could come all the way back down to the midpoint of that channel, right around the 194 mark or so.
Ben, Scott Bauer brought up a great point in the first segment where if you combine how these banks, and especially Goldman Sachs, has acted during the first half of this year with what has happened to the 10-year yield, can they claim a small victory here? And any breakout of the range that they've been in should be seen as not a little positive, but I think really positive.
Yeah, I think you have to look at it that way because, you know, we see this breakout. It came back and it's retesting the top of what was the old channel. It's giving us a little bit of a bearish engulfing candle here, but if it bounces on this earnings announcement and we see a little bit of a pop to the upside, that would be consistent with the build that we're seeing in momentum down in that bottom panel. The MACD just giving us an indication that on the rise, that stock is attracting some oomph behind it. And so that may be, again, consistent with what we're seeing in all of these other technical indicators here.
And Ben, what do you think is going to be most important in the Goldman earnings report? Is it going to be what they've said about interest rates and what may happen, or is it going to be trading revenues?
You know what? I think trading revenue is certainly one of the things that is going to impact this stock. You know, they've recently reduced some of their payout rates on their online savings accounts, so margin compression may be the story that they tell going forward. And so how analysts react to their indication of short-term, long-term spreads on loans, that may be part of that process as well.
All right, Ben, let's keep moving now to the mother of all big banks, and that is Jamie Dimon's little secondary little passion, which is Jpmorgan.
Right. So again, long-term gentle uptrend here, maybe a little bit different than that sideways trend that we saw on Goldman. Now, price broke out of an inverted head and shoulders pattern a few days ago. And this is a stock, if you look at this, it's been moving in that type of pattern. It pulls back a little bit, it rallies a little bit, it pulls back, and it gives us these inverted head and shoulders patterns. It broke out of one here with that neckline kind of right around the 116, 118 range there. If it moves to the upside, that target maybe put it to around the 120 mark, which is close to those previous highs, a little bit beyond. That type of pattern is consistent with really some inconsistent momentum, which is what we see on the bottom here. We see strong moves to the upside, and then it pulls back a little bit. So this is one of those technical patterns that depends on the price of the stock moving at levels of support and resistance.
Ben, with an expected move right around $2.50, correct me if I'm wrong, that takes you into some pretty interesting areas on the upside here, where things can get a little dicey, right up around $117. That's kind of a technical busy spot for this stock, right?
Absolutely, and technical busy spots generally, not always, are levels of support and resistance, and there's no guarantee that those are going to act as support or resistance, but when they've done it before, sometimes they do it again, and that's maybe what this runs into in that level.
And what if we get a really good report, Ben, and this thing breaks out through that 117 area? Do you think we get back to those new highs, over new highs? Are we going to get maybe over exuberant on JP?
And that's very a reasonable expectation here, given the price target on that inverted head and shoulders pattern, putting it up at around 120. Now, there's never a guarantee that the price is going to go there, but it's done it before with this type of pattern on this stock and others, and so that's why those expectations become expectations, but momentum may be falling off just a little bit, but still building on the right-hand side, which is a good sign for that breakout.
Mr. Ben Watson joining us live from Salt Lake City, Utah. Thanks for coming out, buddy.
Thanks, guys.
All right, let's dig in, Scott Bauer. Let's dig into Jpmorgan now and see what you think here. Again, these are moves that aren't jumping off the page at us, but I mean, when you look at vols in the low 20s and then you only get to 28 on the earnings event, not getting my heart rate up as in terms of a big event coming, but $2.50 move in these names, it's bigger than they normally move for sure.
It is, and you just made a great point about the volatility, is that, you know, you don't really see that front month, that earnings volatility in a JP go off the charts here.
These are not the same expected moves as you would see in tech stocks or something like that, right?
Exactly, which for me, the perfect kind of setup here in a stock like this would be a calendar spread. Pick your direction, up or down. Now, personally, I like the upside. Pick your direction, and you're still able to buy some really inexpensive volatility, inexpensive premium, going out maybe a few weeks, selling this week's premium against it.
Yeah, I mean, you've got vols out 30 and 60 days, right around $20, 20 or 20%, even lower than 20% in a couple places. So, yeah, in terms of cheap summer vol. Now, let's talk theory for just 1 minute as we get into this trade. I talk on this show all the time about buying calendar spreads in the summer. I like doing it, but I want my long side to be after Labor Day, because for something that will, by just pure human nature, it'll hold vol more than something in the summer will.
I agree with that. However, the one thing I would say right here is if I'm able to sell a little extra premium, and I know that's not that expensive because of earnings, I'm willing to buy an August option here, as opposed to going out beyond Labor Day. But otherwise, Kevin, you know, you and I have been through this. Totally agree with you. You get to keep the volatility higher if you're post Labor Day. But I would take my chance here on a 1 month spread or even a 3 week spread here.
Now, we have to go with our shorts in the front expiration, right? You do advise that.
Absolutely.
So are you talking about something, let's say, maybe the 120 calendar?
120 is great.
We'll buy 30 days out and we'll sell right into this expiration. And let's see where the 120 gets us. Not a lot of premium in the 120.
So
let's go. And we don't have, if we don't, we got to stay, I think what we got to do is we got to stay weeklies.
Yep.
Because, so you get the dollars. Let's go maybe the 9th.
And then you could do like the 118.
There you go. I think that'll give us more premium in this front month because it's much closer to that look. Let's go back now and check the 118. As you can see, 36 cents. That's not bad for the price of Jpmorgan and where we are. So you see, 63-cent debit on basically a month spread, three and a half week spread.
And what I really like about this is two things. A, the stock doesn't have to get to 118 here on the earnings move to make money on this.
For you to double your money on this.
Right. We know we're going to see a big vol contraction after earnings.
Right.
Both this week's and the August 9th options are going to go down in volatility. It's just a matter of arbing one against the other, and hopefully the volatility crush that we see in this week's options will more than outweigh what we see in the 9th. Now, it also gives you the opportunity for a roll and collect more premium if you wanted to roll the short option this week out to next week. So I like this setup a lot.
I just want to check for our viewers in the other direction. Let's go with like a 112 put calendar and see what we got there. Probably a little more expensive, and it is because of the skew.
Yep, absolutely. And again, I'm biased towards the upside here, and I think that an upside calendar play, both from a volatility perspective and the directional perspective, is a really good, safe play for earnings here in JP. And
there's the opposite.
Totally risk defined.
There's the 112 calendar on the put side. If you look, there's the 118 on the call side. And if you have one of those situations where you like a trade like this, but you're not sure, you can do a double calendar. Sure. Now it costs more, right? That's about $1.40 to get that on, but that's one where you can. That's a move either direction. And remember, you're collecting theta. It's relatively low risk. It's not zero risk. It's not high probability, but it's good fair probability. And you know that, Scott. Old traders like us, we love calendar spreads, especially in low volatility environments.
Exactly. And this is, again, like you said, if you're looking at either direction here, I personally favor the upside here, but you could definitely do it for either direction.
I think the action in Citigroup today and how we've seen it and the size of Jpmorgan, I too favor the upside. So we're just going to put it on the 118. We're going to put it on 5 times. And there's a 118, 62 cent. And as you can see right there, we'll throw that on. And there's 5 calendar spreads going in earnings. Remember, that is buying basically 3 weeks out, a low implied volatility, and selling the front expiration event volatility against it. All right, Scott Bauer. Coming up next, it's our cash tag segment. Megan Brantley from Likefolio joins us to let's talk about pizza. Domino's Pizza is in the news. It's got earnings tomorrow morning, and we're going to talk about it right here on the TD Ameritrade Network Fast Market. We'll be right back. Welcome back to Fast Market, everybody. I'm Kevin Hinks, joined again by Scott Bauer, CEO of Prosper Trading Academy. Scott, these E-minis don't want to do anything. They're down a quarter of a point, and they're not moving very much. Russell, down 0.5% though, not real. The Russell has been an outlier here for several days now, both up and down. Yep. It's one of the outperformers. Why do we think that is? You know what? What we can do for our viewers and take a good look is if we go to our Analyze tab, we can go to the Market Watch, we'll go to Visualize, right? And then we can put up our indices and choose the Russell 2000. And you can see its financials today, although it's across the board. It's not big weakness. Consumer discretionary is a little lower, but look at financials. I don't see any green in those at all. And that's coming off Citigroup's earnings, right? I mean, they're all a little bit weaker. So that really seems to be weighing. And if you look, it's a pretty big percentage of the Russell 2000. So a little bit of weakness in the financials weighing down the Russell.
And last week we saw strength there.
Yeah.
Right? So that's why you almost had the Russell outperforming on the upside last week. Today the financials a little bit weaker. So you see it, outperforming to the downside.
For an unchanged market, that is pretty red across the board in terms of the Russell. All right, let's get into our feature stock of the day, and that is Domino's Pizza. Now, it's a little different of a scenario in Domino's Pizza because no weeklies. Even though you have a week expiration, a monthly expiring this week. I shouldn't say weekly. Monthly expiration expiring this week.
Absolutely, and your strikes also are $10 wide up here.
Right.
There's no even $5 wide strikes up here. Makes it a little bit different how you evaluate and what you want to do up here. But you're right. You don't have that 7-day, that week to week, and that's why if you go back to the previous tab here, you'll see that massive disparity in vol,
right?
Unlike what we saw in Jpmorgan earlier. Yep.
Right? From 2 months out, the vols are double.
Exactly.
Much bigger. And some of that has to do with probably the movement of the stock.
Sure.
Right? The expected move is what? Over 5%. So that's significant. And you're right. I mean, this is a name whose front month vol is 63 and 60 days out is 30. So that's a big disparity there, but that's an opportunity. If we play it right, that's an opportunity.
No question about it. And you know, whether you look at a calendar spread or a straight directional here, you absolutely have to take that volatility into consideration here, because with only 4 days left for expiration now, boy, are we going to see a collapse.
Right. And look at the Sizzle Index, which measures volume today versus volume over the last 5 days, and you're talking about 10 times the put volume. So there's something going on here where people are making some bets, not crazy numbers, but still bigger than normal in this trade. So just to recap, like Folio's data, pretty bearish in terms of a move in Domino's. They've got the stock going up, but overall consumer interest going down in Domino's. They think they're lagging behind other food service in the delivery department. Shocking that someone like Domino's that made their bones on a half-hour delivery is now lagging behind other delivery systems. So that's like Folio's data on that there's some divergence there. So how do we take advantage of that? Let's make an assumption that our first thought is bearish in Domino's. Okay.
So you can do, you can look at something just straight directional, right? Just a vertical put spread. You can also then look at a calendar put spread to the downside.
It's $270, 15 might get you around the 250 or 260. You're
right, and that's with no $5 strike.
Exactly.
So I would probably err on the side of going lower. So I'd go choose the 250.
All right. Let's go 250. We'll go 32 days out versus 4 days out. And let's see how much premium we can get there. 250, still $1.55, $20 lower.
Yep. That's
telling you something about what's going on. But remember, this is bigger numbers, bigger overall. So $1.93, not, seems a little expensive to the naked eye, but you're talking about $207 stock.
Exactly. So it's really less than 1% of the value of the
That's
stock.
where you got to look at it, right?
No question about it. You have to be able to compare apples to apples. The one, I would say, maybe downfall in a calendar scenario in a stock like this that does not trade weeklies is the inability then to roll.
Right, exactly.
The inability to roll.
You're either right or you're managing another way, and and this is the very next expiration. So really all you can do is trade out of it or turn it into a straight vertical. Right. It's really, you've got two choices.
Exactly. But if you are bearish, this is one way to capture both a bearish move and that big discrepancy between implied volatility.
Yeah, but there's still choices, right? I mean, if it goes on the downside, doesn't get to 250, which makes a nice expansion of this trade, obviously the first choice, close it, right? But if you want to turn it into like a vertical, you could sell a July 19th, 240 put.
No question.
July 19th, 230 put based on where you are. You could, if you're bullish, if it moves down there, you could sell a 260 put and make it long deltas. There's choosing the strike prices, choosing how you evaluate this move is key here.
Yeah, no doubt about it. And again, I like the downside in this one, like you had just said. So we can evaluate this, and then let's also look at it, maybe what the 260, 250 put spread of this week is as well, and see what the reward to risk on something like that would be.
There's our first look. And there's the calendar spread. As you can see, a pretty sharp up move if you get a move towards that 250. And like Scott said earlier in the program, you do not need it to get all the way to 250 to be very profitable on this name, especially when you're talking 1 month versus 4 days.
Right, because that July option that's expiring this week, that thing is just going to implode really quickly. So even if you got a move down to even 260-ish, or just thereabouts, maybe a tad lower, that thing is still going to work for you really nicely.
Think about this. You could get a move. If you play this poorly and are uneducated with options, you could buy the front month $250 strike in dominoes, get a $15 move in your favor, and lose all your money. That's what you have to avoid. That's the pitfall that you have to avoid in this name.
No doubt about it, especially because it's happening so quickly with 4 days left.
And it's why that front month must be sold. It must be traded against. I shouldn't say must. It's never must. But that's why buying that front expiration brings in so much risk. You could be right and still not make money. And that's what we try to avoid here.
Absolutely. You have to look at the probabilities here. You do, because the probabilities don't lie.
Right, exactly right. And what Scott's talking about here are the probability of in the money in that July 250 put, 85% chance that will finish out of the month. That is what we call a high probability trade. So let's start right there. I think this is a trade that's relatively low risk if you're playing the downside move, which like Folio tells us we should. We can get in that for about $1, just under $1.90. Let's do $1.90. We'll do that 3 times.
You know what else I like about this, Kevin? If you can put that in and you go back to the Analyze tab, let's say Domino's has just horrendous blowout to the downside, and it moves past 250. Let's say it even goes down to 240, 235. You have collected so much premium on that short option here that you can see the break even.
You're still profitable.
We're protected all the way down to what 225 or so?
Right. I mean, here's the way you do it. You set slices to break even, throw it on there, and it gives you the number. It's about 223.19, I think that says.
So
you got a lot of
room for error there.
Look at all this room here. Look at there's 215. There's all these numbers right here. I'm sorry, not 215. You can see the price changes, and 240, 235 still profitable on this trade.
Exactly. And even on the upside, we could be wrong a little bit. As long as the stock doesn't blow up to the upside, stock can even be up probably just a tad, and at worst case,
if it were to be unchanged, you'd probably make money on this. Even with directionally you're wrong and away from the market, you'd probably still break out okay. Okay, is there any other trade that you would look at in Domino's that jumps out at you here?
So if you're really directionally biased to the downside with what the market maker expected move is, I guess you probably have to look at the 270, 260 or the 260, 250 put spreads. Not having that $5 increment in this particular instance really comes into play based on what the market maker expected move is, with about a $15 move, because really 255 is kind of that target to the downside here. So that's why I'm saying maybe you look at the 260, 250 if you can.
You're talking about long it?
Long that put spread.
Okay.
If you're really bearish here.
If you're really bearish.
If you're bearish. And you expect that move to happen of about $15, the 260, 250 put spread for about $2, probably not so bad.
Right. It's trading right around $2. Obviously, if it goes to 255, that's $5 on that spread. So that's a number right there. You could see that's a nice little return. Remember, these are all based on a bearish tone that we got from Folio and that we're talking about here.
Exactly.
If you're bullish, obviously the other ways work. There's the short put vertical. From a bullish perspective, there's so many things you can do. The calendar spread from the other side, there's a lot of things you can do. But what we're going to do, we are going to do 2 of these. We've already got calendar spreads on in Domino's, but we're going to match that up with 2 long vertical put spreads again. So we're going to play the downside move, play it a little aggressively. We've got a calendar spread on and a long vertical. So both those are what we're going to use to take advantage of Domino's Pizza.
Almost the Texas hedge there.
Exactly right. Yeah, we know what that is. All right, Scott Bauer, CEO of Prosper Trading Academy, thanks for coming out.
Thank you.
Filling in today. You always show up when we ask you. All right. That's our show for today, everyone. Please join in tomorrow at 10 a.m. Central right here on the TD Ameritrade Network for another edition of Fast Market. And goodbye to our girl, Amber Moten. God bless. Enjoy Portland. We're going to miss you. Thanks, everybody. Have a great day.